if I take $100 that I earn from my job and I deposit this $100 in my bank, the bank isn't going to just keep this $100 in a vault somewhere. They're going to immediately work to lend out most of this money. So typically banks are required to leave somewhere between 10% of this money in reserves. So if I deposit $100 in the bank today, I get a receipt saying that I have $100 in the bank. But then the bank is going to take this and they're going to take the $90 out of my 100 and they're going to lend it out to somebody else. Now, the bank only has $10 of mine still in the bank. However, I can go and withdraw $100 anytime. But the bank doesn't have my $100. So what happens there? It might be a little bit easier if I diagram it out. So here I am with a mustache, or as we like to call it in my native language, Punjabi, a much. I deposit $100 in the bank. Now the bank is going to give me a receipt saying that I have $100 and I can withdraw this cash anytime I want. But immediately after I give the bank this $100, they're going to work to loan out $90 to this lady right here who has a braid, or as we like to call it in my native language, Punjabi, a gut. Now she has $90 out of the 100 that I gave the bank, but I can still get my 100 back anytime I want. Now this lady who has $100 is gonna go and purchase something. Let's say she buys, I don't know, we can buy some extra guac from Chipotle. And now Chipotle is gonna take this cash and they're gonna put it in their own bank. So now this is bank 2, and bank 2 is gonna get a $90 deposit. Now what happens? Bank 2 gets $90 and it says that this $90 can be withdrawn at any time. However, bank 2 isn't going to keep $90 in their vault. They're going to take almost all of this. They're going to take 90% of this and then they're going to lend it out to somebody else. And so now this is going to be around $80 that gets lent out to person number 3. Now what happens? I can still go to the bank and pull out my $100. She can still go to the bank. I'm going to assume now that we didn't go to Chipotle, but if she just deposited this in her own bank account, she can go and pull out her $90 anytime she wants. Person number 3 can do the exact same thing. So what happens is you deposit $100 in the bank, but anytime you do that, you are producing more inflation through the banking system because banks work with an entity called the Federal Reserve Bank, and if everybody tried to pull their cash out, well, then banks would run out of money, and that's where they can work with the Fed, the Federal Reserve Bank, who keeps funding the banks in case they need more cash. However, this system is called fractional reserve lending, which allows the banks to lend out money that they don't even have. So the banking system, the fractional reserve banking system, is inherently inflationary by nature because anytime somebody deposits money in the bank is going to work to lend that money out and print more money because it allows the banks to make big profits because they can keep lending out the same money again and again and again. But in order for this banking system to work, and for it to produce inflation, it needs people and it needs institutions to keep borrowing money. So let's talk about now how people create inflation. So we have this happy couple here and they collectively earn $100,000 a year, and let's assume that out of this they also have $40,000 in savings. Now they want to go out and they want to buy this home, which is on sale for, let's just say, $200,000. Now, they don't have the cash to go out and buy this home. So what do? Well, they go to the bank and they say, hey, bank, we have 40 grand in the bank. We're making 100 grand a year. We want to buy this $200,000 home. And the bank is going to say, great, we would love to finance you. You have the cash for a 20% down payment. We will lend you the other $160,000. This money is coming from the bank. Well, this bank has to get this money from somewhere, and it's coming from the deposits, and it goes back to the fractional reserve banking system. The banks don't just have all this money there. They have to create some of this money. So this money essentially has to be created out of a fractional reserve banking system. That way the bank can give you the money to go out and buy this property because you are taking out a loan, which is debt. And debt is when you're using tomorrow's future earnings. That way you can spend it today because you don't have the cash to go out and buy this $200,000 property, because if you did, you'd be operating on a money-based system. But we're not operating on a money-based system. We're operating on a credit-based system, which means you're not spending money based off of how much cash you have. You're spending money based off of how much credit you qualify for. The third way that we have inflation is from the government. Now, if we just take a step away from the government and we look at how businesses look at their income and loss statement, the way it works is you take your revenue minus your expenses, and this equals your profit. But the government is similar but a little bit different because the government is not looking to make a profit. The government is not a for-profit entity, and they don't sell anything to make a revenue. The way that the government works is they get tax dollars from taxpayers. So you go to work to make money and the government is going to tax your income, or you're going to go out and buy something and the government is now going to tax your purchase. Maybe you get a sales tax, maybe they get a property tax, but the government doesn't get a revenue. Instead, they get taxes when you spend money or when you earn money. So you earn money, you pay taxes, and then the government has their expenses. And then if there's any money left over, this is what's called a surplus. However, a government has not been running a surplus, it's been running a deficit, which means that the government has bigger expenses than they do actual tax income. So if the government is spending more money than it brings in, well, it's got to cover that cost from somewhere. Well, this is where the government works with the Federal Reserve Bank, again, which has the ability to print money, and the Fed can then give this money to the government in the form of a loan, or in this case, it's actually in the form of a treasury bond. So the Fed creates money out of thin air, gives it to the government, and now the government can spend way more money than it brings in. This is what allows the government to do a lot of things, because when the government spends money, somebody has to pay for it. Either you're going to pay for it in the form of taxes, or if you don't pay for it in the form of taxes, you're going to pay for it in the form of inflation, which ends up being a hidden tax. So if the government wants to pay off everybody's student loans, or they want to pay off your credit card debt, or they want to pay off your mortgages, they can do that. But there's a cost to that. Somebody has to pay for this cost. Either they can raise your taxes to fund this payment, or if they don't raise their taxes, they can cut their costs, they can cut their expenses, they can cut Social Security, they can cut different entitlement and welfare programs, they can cut whatever. Or if they don't want to do either of those two things, they can just print this money with the help of the Federal Reserve Bank and give out money to people. The fourth entity that can create inflation is the Federal Reserve Bank, which is the entity that I've been talking about. And although the Federal Reserve Bank is called the Federal Reserve Bank, they are not federal. It even says so on their website. They're not a reserve. They don't keep cash reserves anywhere, and they're not a bank. You and I can't go there to deposit money. However, they have the ability to control our monetary supply, our money system, and the way they can do that is by two things. They can do this through quantitative easing, aka money printing, or they can do this through controlling and managing interest rates. So with quantitative easing, the Fed has the ability to print money essentially on command. So if the government wants to spend $4 trillion on whatever they want to spend it on, it doesn't really matter. If the government wants to spend $4 trillion they don't have, they can call up the Fed, and then the Fed can use this quantitative easing power, aka money printing power, to print money out of thin air. Remember, they don't have a reserve anywhere of cash, so the Fed prints this money out of thin air, they give it to the government. Now the government has increased their deficit. They have just spent $4 trillion that they don't have because now the government can spend this money. And now, again, somebody has to pay for it. Who pays for it? Well, the people that don't understand money, the people who don't understand inflation, and it's the financially uneducated, and typically it's the poor and the middle class, because the wealthy who understand how the system works are going to be adjusting how they use their money. That way they can benefit from the inflation. So the Fed can create this sort of quantitative easing to create more inflation, to help the government spend whatever money that they want, or the Fed can also adjust interest rates, which affects inflation, because now if the Fed cuts interest rates, that makes borrowing money cheaper. And what does that do? Well, it increases how much money the bank is going to lend out. If we go back to the fractional reserve banking system that I just talked about a couple minutes ago, well, if it's cheaper to borrow money, more and more people are going to be interested in borrowing money, and that means more money is going to be going out for people to buy homes, for people to buy cars, for people to spend money on their credit cards, and this creates a boom in the economic system in the short run. However, it increases inflation. If you enjoyed this shorter clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to invest your money in real estate, our team put together an amazing guide on real estate investing. This guide goes over what real estate investing is, how to start using real estate to generate cash flow, and how to build wealth with real estate. This guide is completely free when you sign up for our daily newsletter. So if you want to read our guide on how to start investing your money in real estate, you can download that guide just by clicking that button right over there. Thank you for watching, and as always, keep hustling.